And my name is Garrison Gilbert. We are Multifamily Masters. This is Multifamily Masters Live. We do this every month. Generally speaking, it's the third Wednesday of the month. We bring in a guest speaker. We bring in a panel. It's all about creating community. It's all about creating camaraderie. It's all about learning the intricacies of this business and surrounding yourself with the right people. And we have the right people on tonight's episode. We have Miss Erin Brown, my co-host, Miss Elsa Nguyen, my business partner and co-host, Mr. Jim Ross, our CPA and real estate tax advisor, who we switched to this year. And I'm not going to get into the details, but we saved a boatload of money whenever we shifted gears. Nothing against my old CPA. He's a great, great, great friend of mine, an awesome, awesome guy who I've actually bought real estate with. Nothing but respect. But we switched gears because it's all about the savings. It's all about implementing the exact strategies that we want to implement. So, Miss Erin Brown, introduce yourself. Tell us a little bit about your real estate experience, where you're from, about your meetup chapter. Give me a quick 60-second go, 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 and Elsa, take it over.
All right, thanks, Garrison. Good evening, everyone. I'm Erin Brown. I live in Northern Virginia. I have a W-2. I've been investing in real estate since 2019. Financial education completely has changed the way me and my husband live our lives and invest. We are LPs in a couple commercial properties and a couple multifamily, and then invested in some businesses as well. And then our Northern Virginia chapter meets at Craft House in Fairfax the second Monday of every month. So if everyone wants to come out next Monday night, bring your holiday gear and we'd love to see you.
And real quick, Erin has a rocket scientist background on her screen for a reason. In our mastermind, I always talk about how simple this business is. You do not have to be a rocket scientist. She happens to be a legit NASA rocket scientist. So she put that background up just so to remind me that I'm not the smartest guy in the room, which I like to be the dumbest guy in the room. Miss Elsa Nguyen, take it away.
Hello, everyone. My name is Elsa Nguyen, and I am Garrison's business partner, co-founder of Invest Now Capital. Together, we buy apartment buildings. We do land development. We buy single-family house. That makes sense as well. So we have a little over 200 units in our portfolio right now, about $40 million assets under management. And we are continuing to grow very conservatively. I have an accounting background. I work as a controller up until 2016 when I quit my job because I felt caught into real estate. I don't know how true that is, but real estate makes me happy. Just the ability to work with my own time, and I don't have to be at an 8 to 5 job. Other than that, I live out here in California. We buy real estate all over the nations, wherever it makes sense. I am more of a number person than a location. So as long as the location is within the checkbox that I have and the numbers work, then we'll find a way to make it work. With that being said, that's pretty much everything about me.
And the man of the hour, Mr. Jim Ross, our CPA, our accountant, our tax advisor, the guy who makes sure that if the IRS calls upon us, our T's are crossed, our I's are dotted. Take it away, my man.
Thank you so much. I'm so glad to be participating with you all tonight. As I was looking at the list of participants, I see a bunch of familiar names in there. So thanks to all of you for joining in. And I think we're going to have some interesting discussions tonight. We had a great session a few weeks back or a few months back, and we talked a lot about like passive activity types of issues and real estate depreciation and all that. So I hope to not beat a dead horse with the exact same content as last time, but there'll probably be a little bit of overlap. And before I get into all that fun stuff, let me just say that I am a CPA. I live in Arizona. I work for an accounting firm called Provision. We're based out of Phoenix. We serve clients in all 50 states and primarily work with entrepreneur and investor clients. So even if you are primarily a W-2 earner, if you have real estate investments on the side or other kinds of side hustles, there's a good chance that we can help you out and find some interesting creative ways to help lower your taxes. As tax planners, we want to look holistically at your wealth. We want to look at where your income is invested, where your cash is invested, where your income is coming from, and figure out in your context what kinds of things you can do to lower your taxes. And context there is the key operative word. What works for Aaron is going to be different from what works for Elsa and for Garrison and so on. And that's why you can't just go online and Google, can I do X and expect to have a clear, obvious answer to what to do in your situation. You've got to have a well-seasoned tax accountant that understands business, understands investment, and that can help you find solutions that fit for you in your context. Okay. So where should we go from there? Elsa, did you have certain topics within tax planning or questions, or do you want me to just kind of steer the ship then as to what we would talk about?
I think you can I don't have anything planned. I know we briefly discussed some of the topics that most people here are probably new about: 1031 exchange, cost segregation. And the third element is the oil, the oil and gas industry investment, which I think is probably new to a lot of us. And I know there's a huge saving there for investor in that particular industry. So you can just take it from there and we go with the flow. We usually, do you want us to go to the question as people put them in the chat, or you want to wait until the end? You tell us how you want how the flow is.
I think probably hold the questions to the end, unless it's, very topical on what we're discussing at the time. And I'll leave it to you to kind of let me know if you want to interject with a question, if you think it's well fitting for where we're at in the discussion.
Perfect.
Absolutely.
Yes.
And anyone watching this, feel free to drop any and all questions in the chat below, and we're going to try to answer everything towards the end.
Awesome. Well, let's start with the oil and gas thing, since that's maybe a different topic from what we went into last time, and the reason why it comes up, especially in Q4, especially in these last few weeks before the end of the year. Why are people looking at and talking about oil and gas? The reason is because they're looking for something that they can invest in that can produce a tax loss, a paper tax loss that can be used to offset taxes from other sources of income. And we talked before about why is the whole passive versus active thing such a challenge? And the reason is because the tax law basically compartmentalizes different kinds of income. You've got active income and passive income and portfolio income. Capital gains can be kind of nuanced as well, and some other categories too. And you can't automatically assume that if there's a tax loss from A, that it's going to offset income from B. If you're a W-2 earner and you produce a tax loss in some other kind of activity, are you going to be able to take that tax loss and use it to offset and lower your taxes from your W-2 income? And the answer, as always in tax planning, is it depends. So if you are someone who's very heavily involved in real estate, the answer is you're getting probably more likely to where you could use a loss from something like that. But in most cases, to take a loss from one kind of a thing and offset tax from another kind of a thing, it hinges on you being very involved in something. All right. So that's the general case. And without going too deep into, what are the material participation criteria? What does it mean to be a real estate professional? That's kind of stuff to unpack with your tax planner one-on-one. But suffice it to say that oil and gas is interesting because it's an exception in the law. It's an exception that basically says you can invest in an oil and gas working interest in an oil and gas fund or operation, and there is inevitably in these types of things a year one tax loss, because they're taking all the capital that was raised for that development, they're deploying it into development of wells, and some of that's intangible costs, some of it's tangible costs, and so there's a big upfront tax loss before revenue is really up and going and being generated. There's a big tax loss up front, and you can use that tax loss from a working interest in an oil and gas operation so long as you do not limit your liability with an entity. Okay, so a lot of people think, I'm going to go, everything I go and do business wise or investment wise, I'm going to do it in an LLC. And you'd be right most of the time. Okay, if you're in real estate, you probably need at least one LLC, maybe several if you've got a lot of different things going on. In oil and gas, if you want to take that tax loss and use it to negate income tax from something else like your W-2 wages, you cannot use an LLC. You cannot use a limited partnership or a corporation. You've got to do it generally in your personal name. Okay. And so you're going to invest in this working interest as a general partner in your personal name. And the result of that is that you can treat that tax loss as a non-passive tax loss. It doesn't have anything to do with how much you participate. Remember, that's different from real estate and businesses in general and so on. Usually you have to participate a lot in running it to treat it as non-passive. But if in oil and gas, it's just one of those exceptions where you can treat it as non-passive so long as you don't limit your liability with an LLC, limited partnership, corporation, et cetera. So the scenario is, I plunked down $100,000 into a working interest in an oil and gas fund. In the first year, I'm going to have a tax loss. How much is going to vary, but you might see the sponsors raising money on these kinds of deals, suggesting that it's 75%, 80%. Those would be common percentages. It's not a fixed amount. It does vary, but they might say we think it's going to be 75% in the first year, and that would be a relatively common amount. And so then you'd have a $75,000 tax loss that could offset any other source of income that you have. Okay, wages, interest, dividends, capital gains, business income, etc. All right. So what does that do for us tax-wise? Let's pretend, for just example, say continuing on with the $100,000 investment scenario, I'm going to get a $75,000 tax loss on that investment. What's my tax rate? Okay, if I'm in California especially, and if I'm in higher tax brackets, I may be paying 50% just in income tax. All right, 37% for federal, 13% for state, and maybe some other taxes are going to apply too. So if I invest $100,000 in an oil and gas fund and it produces $75,000 tax deduction, how much is that saving me in year one on my taxes? 50%, 50 cents on the dollar on a $75,000 deduction is $37,500. So immediately I have taken $37,500 of taxes off of my tax bill. Okay. Now I invested 100, right? And I've saved 37,500 right out the gate. So I still have some skin in the game. I've got the other 62,500, whatever that is, to recover. And presumably I'm going to invest in something that produces oil and gas, and there's going to be a revenue stream. I'm going to have cash flow as the royalties start to kick up. So you almost never invest just for a tax deduction, but it is nice where in some scenarios like this, you get an upfront tax deduction. It's almost like you've subsidized the cost of that investment, and now you have 2-3 years to collect cash flow on the thing, maybe, and depending on how they structure the deal, it may be a longer play where you're going to have cash flow coming from operations for several years, or maybe a shorter play where they basically get it up and running and then they sell off the assets to another company and you get paid out at that point. But this is something that the wealthy have been doing for years, okay? Because they have cash, they're losing buying power to inflation. They, if it's December 6th and you're looking for what can I put money into quickly before the end of the year, it's one of those things that comes up, okay? Real estate's great too, but go and find a deal and close on it by December 31st and have the property be in service right away. If you're not already on the finish line, that's a hard position to get to, right? Any questions before we go forward from after that mouthful of oil and gas?
Yeah, Jim, so you said that you had to invest in your personal name and not an LLC, but someone asked, does it matter if it's a flow-through entity? Does that make a difference?
It does if the entity limits your liability. That's ultimately what it comes down to. So, I mean, in theory, a general partnership may not limit a partner's liability, but a limited partnership would, and an LLC certainly would. So in most cases, yes, the entity, just by virtue of how people set them up, usually has built-in liability protection, and that's usually going to be a problem if you're trying to do this. Okay. Another thing to just be mindful, and this applies not just to oil and gas, but other business types of operations. There are some limitations that can apply, especially if you're talking about big dollar amounts. Okay. And there's a limitation called the excess loss limitation. This came out a couple of years back, basically starting at the $500,000 threshold. If you have both business and non-business income, okay, you start with the business stuff and you kind of net everything together there. And if that's a loss, you can only take up to $500,000 of that loss and use it to negate non-business income. So the question comes up, I have $1 million in W-2 income. Can I offset $1 million of W-2 wages with an oil and gas loss? And the answer is probably you can only offset 500,000 of that W-2 income. It's actually inflation adjusted now. I think it's 578 this year because they've ramped it up over the last couple of years. But yeah, there are limitations on how big you can go with this. So that's where you want to meet with your tax planner, scratch out the scenarios that apply to your situation. It's going to vary to some degree. Okay.
Interesting.
There was a question if this tax loss only reduced passive income.
Not necessarily. And so you actually typically can have the option when you invest in something like an oil and gas deal. You usually have an option of whether to be a limited partner or to be a general partner. And it's not like with the typical syndication on real estate side where we're talking about apartment complexes where the GP group has a carried interest and the allocations different. With oil and gas, it's really just they'll let you be a GP if you tell them that you want to be one, and assuming you're an accredited investor. And there will be hundreds of them in a deal in some cases. And that doesn't mean that their allocation's different. It just means they haven't limited their liability, and the GPs can use that tax loss to basically offset non-passive income. So you're making that investment non-passive, and it will offset any income that you have. On the other side, if you just want the cash flow because you like the logistics of the deal, right? If it looks like it's going to be a very profitable deal and you're not trying to create a tax offset today to negate W-2 income or business income or something like that, you can invest as a limited partner and you'll have limited liability, and that would be a passive loss and it would only offset passive income in that situation. But that comes up a lot too. I mean, think about...
Here's just a general question.
Sure.
Why does the IRS classify it differently from real estate to oil and gas, as in you can have 3,000 GPs and every person gets this tax? What's the difference? Why is the classification so different?
Well, so at the end of the day, if you look at what goes into the tax law, you touched on, it's designed by the wealthy, and I could hardly disagree. But a lot of what's in there is designed to incentivize something. They want to cause the public to act in certain ways. Why are real estate investments highly tax advantaged? The government wants you to invest in real estate. It's good for the economy. It creates housing and so on. Why do they give you a tax break for oil and gas? To incentivize you to invest in oil and gas.
Sure. My question though is why is the incentive so much more lucrative or so much more advantageous in the oil and gas field versus the real estate field?
I wouldn't say
what makes the IRS give that incentive.
Well, it's not the IRS, it's Congress, right? Congressmen write the tax law. And this is something that's been around for a while, and times have changed. I would say the sentiments of the public as it pertains to fossil fuels is a little bit different now than what it was maybe 10 years ago. But this comes from an older time period where my read of it is basically our Congress and the population as a whole too have historically thought that we were too reliant on foreign production, right, of fossil fuels. So how do we incentivize people to put more money into domestic production? Tax incentives is one of those things. I think real estate is also very heavily favored tax-wise. Why is one more than the other? At the end of the day, what you're really talking about here is a timing difference. Okay, so yeah. It's not that you're going to get to deduct more in the longer run. You're just getting to deduct more in the first year.
Gotcha. That makes sense. That's a very good explanation. Thank you.
Absolutely. Okay. Should we go on to some other things? Are we good on oil and gas for now? Yeah.
Yeah, absolutely.
Okay. So, in the role of a tax planner, and especially at this time of year, toward the end of the year, we are meeting with lots of people trying to pull different levers before year end. What can I do while there's still time left to have a better tax outcome? And you should be doing this with your CPA, with your tax planner. Okay. There are almost always a half a dozen different things that you can do before year end that can actually help you save on taxes, or if nothing else, defer some tax if it makes sense to do so. So oil and gas is one of those things that people look at, that's something that you can put a bunch of money into in a hurry without having to spend a lot of time on it. So that one works well. Real estate's great. Again, the trick with real estate is that for you to take a depreciation deduction on real estate, you have to close on it before the end of the year, and it has to be in service. It can't be something you're building or something that you're renovating. It has to be, if it's a rental property, it's got to be available for rent. If it's commercial property that's being used by your business, that's a construction business or something, just has to be ready for you to start using it at the time that you closed on it before the end of the year. Okay. If closing on real estate isn't in the cards because you haven't already started that process and your horizon's too short for the end of the year, there are other things that you might do in the context of real estate. I know we've got a lot of real estate investors here in the group, so just kind of speaking to that. Do you need if you run real estate businesses, do you need a business vehicle with which to do that? Do you have a business vehicle that you use to go and check on properties and meet with people and to run your business with? A lot of folks look at buying business vehicles before the end of the year because you can take a bonus depreciation tax deduction on the business vehicle. Depending on the kind of vehicle, if it's over 6,000 pounds, there's a good chance you're going to get a bigger bonus depreciation deduction than you would for like a four-door sedan, something smaller and lighter. If it's over 6,000 pounds, typically you're not having a limitation on how much of a deduction you can take. So you buy a $60,000 SUV and it's over 6,000 pounds, great. You're probably going to get to deduct up to the purchase price of that vehicle. Certain electric vehicles or hybrid vehicles have tax credits tied to them. This has gotten pretty nuanced in recent legislation. It used to be much more straightforward. So I always say, if you're interested in buying an electric vehicle or hybrid, go online, look up that vehicle. There's all kinds of information about which vehicles have tax credits tied to them. Also, the dealerships have to kind of be on top of this too. So if you go to the dealership and you say, hey, what's the tax credit on this Tesla or whatever it is, they can give you the information as well, and typically are going to certify to you this vehicle qualifies for a tax credit. And that's great. While we're on that, this is something that's commonly misunderstood or not sufficiently understood. Why are tax credits so great, right? What's the difference between a tax deduction and a tax credit? Okay. The difference between a deduction and credit is the tax rate. Okay. Imagine a sandwich, right? At the top is your income. At the bottom is your tax. And in between those two, the meat, that's your tax rate. Okay. If you have 100,000 of income and your tax rate's 25%, your tax is $25,000. Where does the deduction go? The deduction goes up here. It pulls the income down, but you still have to go through that percentage to lower the tax. So if you have a $100 deduction and your tax rate's 25%, you're only saving 25 cents on the dollar, okay, on your taxes. If you get a $100 credit, where does that go? Well, it skips the first two layers. It goes straight to the bottom. You've taken $100 of tax off the bottom. That's what credits do. So credits are worth more than deductions. If you can get credits, they're great. There's electric vehicle tax credits. There's solar panel tax credits. Again, with the solar panels, you've got to have the solar panels up and going by the end of the year. All right. So if you haven't already started that process, it might be too late, but plan ahead for next year. Okay. It's still a good opportunity to, reduce carbon emissions and save on taxes while you're at it. Run the numbers to see how effective that is as far as the cost and the tax credit compares over the longer run to the savings on your utility bill. In some areas, it's more beneficial than other areas. Okay, it depends on where you live, what the utility company offers, and those kinds of things. But I think it's worth looking at just purely from a tax savings perspective. I also mentioned cost segregation studies. this is something that you should look at because you don't have to have the study done before the end of the year. Okay. If you already own property and you're renting it out, and it could be a vacation rental, it could be a long-term rental, it could be apartment complex, commercial, whatever it is, assuming it's in service in some way to produce income for you, you can get a cost segregation study as long as it's done and ready before you file the taxes for this year. So we're in the 2023 tax year. When are you going to file the taxes? Not until at least probably February, and that's early. If you're invested in apartment syndications, you may be waiting until April or May or June. I mean, I've seen some scenarios where the K1s were trailing well into the year. And so you have time to implement on cost segregation studies. All right. So what does that even mean? What does it do? Well, think of a property that you paid $1 million, just for nice, easy, round numbers. You paid $1 million for a property, and some of what you bought is land, which is not depreciable. You don't get to depreciate the raw land portion of your purchase, okay? And some of what you bought is building. Building is either 27.5-year property or it's 39-year property. Depends on whether it's commercial or residential, and the number of units is irrelevant. Okay, are people living in it, or is a business operating there? Okay, 1,000 units in an apartment complex, that's still residential. So that's a long period of time in either case to take the cost of a property and deduct it on your taxes over 27.5 years. Those would be little tiny deductions over a long period of time. But some of what you bought is other stuff. Some of what you bought is furniture and fixtures. Some of it is land improvements. Land improvements is like, what did we do in and on and around the land, but that isn't the building itself? Okay, grading, pavement, electrical work, fencing, landscaping. Think about in an apartment complex, there's all sorts of amenities around the units that people live in. This is stuff, a lot of that can be accelerated and depreciated in a faster time frame. The Tax Cuts and Jobs Act came around in 2018 and said anything that would have a depreciable life of 20 years or less in the law, the class life, as we call it, is eligible for bonus depreciation. So what does that mean? The furniture and fixture type stuff, 5-year property, 7-year property, 15-year property, which is the land improvements we were just talking about. All that stuff qualifies for accelerated bonus depreciation. Okay, so a cost segregation study is just saying, look, I paid $1 million for this thing, but look, 100,000 of it was furniture and fixtures, and 80,000 of it was land improvements, and it dices up your purchase price into these subcategories and gives you the data that you need to go onto your tax return and to accelerate the tax deductions of those items. Otherwise, you're gambling that you're going to take a huge tax deduction on your taxes and you're not going to have adequate evidence. And I'll tell you that a good cost segregation study very often has 50, 100, 200, 300 pages of data. Okay, these are engineers. They take photographs, they take measurements, they evaluate the quality, the life, what kinds of materials are being used. They're going to give you a packet of information that basically gives you what you need to accelerate and take a big tax deduction with this cost segregation study. So again, you don't have to have a cost seg study done before the end of the year. You just have to identify, okay, I've got rental properties somewhere in my portfolio. They haven't been cost segged before, so probably what's going on there is very slow conservative depreciation. And I'm going to identify which properties it's going to be cost effective to do a study on. And then when I go and file my 2023 taxes, I'm going to use that data to take a big tax deduction. Now, if it's a new property, it's very straightforward. It's basically the study is going to say, here's how we're breaking down the assets, and that's what you're going to use to figure out your depreciation. If you have properties that were put into service in previous years, then it's a little bit more tricky. Suppose you bought a property 3 years ago. And again, you're taking very slow, boring, conservative depreciation on the building. It's 39-year life. Okay, for example, I can still implement on my 2023 taxes a cost segregation study, and I can catch the depreciation up. I can say, look, according to the study and this breakdown of the assets, by year 3 now, I should have had a lot more depreciation than I already deducted over the last couple of years. And to the extent that the cost seg study says my depreciation should have been more than it was, I get to take a big deduction now on my 23 taxes to catch me up to where I should appropriately be per the study. It does take a little bit more paperwork. You have to file a change of an accounting method in most cases. There are limitations on how frequently you can do changes of accounting method. So again, one of those things you want to plan out and sit down with your CPA and talk about and see if you can make that work. But it's still a great opportunity. I mean, I have clients right now who are looking at it, who are going, hey man, I've got these 8 properties. I've been running them for a long time. We never did anything like that before. Can we do it now? And so what you want to evaluate there is, A, how much of a deduction am I going to get for doing this to catch me up to where I should be on the depreciation? How much is the deduction and how much is it going to save me on my taxes? And B, what's going to be the cost of me doing it? There's going to be a cost to hiring someone to do the cost seg study. Okay. And there might be an extra cost to your CPA who's filing your taxes, because now you've made your taxes a little bit more complicated. But if it's going to save you, let's say $50,000 in taxes, and it's going to cost you $5,000 to do it, who's not going to spend 5 to save 50, right? So you first you do that cost benefit analysis, and you can be starting that process right now. Okay, so that you're planning ahead, and when you get ready to do your 23 taxes in a couple months here, you've already got the wheels in motion. You can hit the ground running and get it done. Okay. Another thing to consider with cost segregation is that in some scenarios, it may be more or less beneficial depending on what's going on in your life. So I touched early on about, being active or passive, being a real estate professional, for example. If you are a W-2 earner and you have rentals on the side and you're not a real estate professional because you still spend a lot more time in your W-2 than you do on rental real estate, those activities are passive, and creating a bigger loss there may not help you. You may not be able to deduct that loss against your W-2 income if you're not a real estate professional. So what will doing a cost seg study do in terms of helping you lower your tax on the W-2 side? It may be nothing, okay? Because you may just be creating a big passive loss that you can't use. If you have passive income from something else, you sold property A at a gain this year, and you're trying to create passive losses from properties B, C, and D, okay, that can work. But if all you have is non-passive income and you've got passive losses from real estate, that might not be the right timing. But imagine this scenario. I see this pretty regularly. I mean, people start to figure out, and you could probably attest to this, Garrison, people start to figure out how beneficial real estate can be. And over time, they get more excited about it. They get more involved, they get more invested, right? So
Absolutely.
People start to figure this out, and maybe today they're not a real estate professional, but guess what? 2 years from now, 3 years from now, the pendulum has swung. They've put more and more time and money into real estate, and they're trying to step away from the grind, the rat race. Okay. And 3 years from now, they're a real estate professional. That might be the time to do these cost seg studies. Because again, you can do it later. You can catch up the depreciation. And in that year where they are a real estate professional, now they can use the deduction. Okay. All right. Questions, comments?
I got a question. How hard is it for someone to classify themselves as a real estate professional? By me going and I got a W-2 job, I went and I got my real estate license, or my wife got her real estate license, or my husband got it. Does that make us real estate professionals? How do we classify ourselves as real estate professionals?
Yeah, in and of itself, none of those things actually classifies you as a real estate professional. What it really comes down to is, how do you spend your time? And generally speaking, you need to spend, somebody's putting comments in the chat, 751 hours. Yeah, you have to spend a lot of time on it. And the hardest part, especially if you are working in any other capacity, is that you generally have to spend more real estate time than non-real estate time. So if I'm a pilot and I'm doing rentals on the side, okay, if I would spend 40 hours a week working as a pilot, I would have to also in the same time frame spend 41 hours a week on real estate. It doesn't happen. Okay. Now, if you have a part-time job, I did have a pilot client, that's why I mention it, who flew on kind of like a contract basis. He wasn't on all the time, wasn't flying all the time. He flew here and there, 20, 30 hours a week, but had like 18 rental properties. And he did spend a lot of time on them. So if you have real estate and something that's non-real estate, you got to log your time. And it's tedious and it's annoying, but you better do it, because if the IRS steps in and says, hey, were you a real estate professional? You better have evidence to show why the real estate time that you've logged, according to this data, is more than the non-real estate time. And you'd have to log both in that scenario. right? I spent 1,200 hours on my job. I spent 1,300 hours on real estate. You have to log the time to prove it. Okay.
Is it a daily log, weekly, or you just basically sign a statement stating that, stating that you spent so and so many hours a week or a month on real estate activities?
Well, so to be clear, the reason you need a log is in case you're audited. And if you're audited, the IRS is going to ask you for a log. They're going to ask you for data to prove what time you spent on real estate. How you physically track it is not something that's spelled out in the tax law. So there are some tracker apps and softwares out there that you can use. You can put it in a spreadsheet, on a Word doc, on a notepad in your car. How you physically track it is not the issue. It's that you just have to do it, and you have to have the data, and the data better support that you were spending a lot of time on real estate, and not just, I looked at Zillow for 8 hours a day. It has to be, something more material, as far as, I was dealing with the tenants and there was an eviction and I collected the rents and there were repairs on this deal and then I did a fix and flip. You have to have actual hands-on time with real estate to actually be a real estate professional, and it's not for everyone. I mean, it does require a lot of time. But what the other thing that can happen too is if you're married and you file jointly, it really could be either spouse. You can have spouse A who's a W-2 and spouse B who's a real estate professional. And so if spouse B doesn't have anything else going on, they're only in real estate, there's probably an opportunity there. Okay, that might be a scenario. If that piques your interest at all, talk to your tax accountant and see if you're not a real estate professional today, maybe you can work toward becoming one in the near future.
Yeah,
I got a couple questions for you.
Yeah.
You touched on the perfect subject for me. No, really, seriously. Let me start with the first question. I did a couple cost segs last year and this year, and I got a huge check back from the government. I paid so little in taxes this year that I paid in the last 5 years. It's insane. In the cost seg, I was under the impression the previous administration, he was a real estate investor, so he allowed 100% depreciation on year one. And then the new administration is dropping it from 100% to 80% to 60% to 40% to 20%. Is that true?
Well, yes and no. That the bonus depreciation limits are going to taper down, that is correct. But it's not an administration thing. In fact, that was what they wrote into the Tax Cuts and Jobs Act in 2018. That was the Trump administration that created that incentive, but they designed it to sunset starting with this year. This year it's 80%. Next year it's going to be 60, 40 the year after that, and so on, unless Congress comes back around and decides to amp it back up. But that's what they wrote into the law at that time, and that's what we're seeing now.
And so the properties that I cost seg, if the properties we got that we cost seg, we want to keep for a period of time. We're planning anywhere from 5 to 15 years. Let's just say the economy turns around, the properties are worth double what we paid for, and we want to get rid of them. In the year that we sell it, it would probably be, someone told me it'd be beneficial to 1031 exchange it to a new property, and we don't pay any tax liability to recoup what we got from the previous years from the accelerated depreciation.
Yeah, I mean, that's absolutely a possible approach, and a good one, one that's going to be more and more utilized, I would say, as those percentages are taping down. For the last several years, when we were at 100% and even now at 80%, a lot fewer have been doing 1031 exchanges, because I could sell a property in March, buy something else before the end of the year, do a cost seg on the new property, and get enough tax loss out of the new one from cost seg that I negated the gain from the property I sold earlier that same year. Why do a 1031 if you don't have to, and if you can get to the same good place as far as negating the tax effect of your sale? 1031 comes with a bunch of hoops to jump through. But as those bonus levels are tapering down, you're going to see people revert more to 1031, because that new property that you go and buy, if you're just doing a cost seg and not a 1031 exchange, it may not produce enough of a tax loss on its own without doing a 1031 to negate the gain on the property that you sold. So yeah, if you sell your property and you do a 1031 exchange, all the, the issues with the capital gain, the recapture, all that just kind of gets buried into the next property. Your basis in the next property is going to be lower than you might think. Okay, if you've deferred a big gain and it's gone into that new property, your basis in that next property is not the purchase price, it's some lower amount. It's effectively what your basis was in the old property carries over into the new one.
So it doesn't double?
Your basis, no, it does not double.
So you're not taking the old one to the new one and the old one and the new one. That's what I'm trying to illustrate.
Well, so imagine you had a property that you were going to sell for $1 million and it had $500,000 of gain that you were going to realize on the sale. If I go and buy a property that's $2 million, my basis in that new property is not going to be $2 million. It's probably going to be like $1.5 million.
Oh,
okay.
There you go.
Because that deferred gain is pulling down the basis of the next one. Now, the $1.5 million adjusted lower basis on the new property, I can cost seg that, but it's a lower amount than what it would have been in just a straight purchase. Does that make sense?
It does, but now, and thank you for taking this call. And I'm sorry if I'm taking up too much of your time. Now, I step into a property and I cost seg my money from the $1 million property, and I take that portion into the new property, and my portion of the new property, my GP split of the new property, is it just me? It's not the whole cost seg of, because the other say I got 3 other partners. I take one to one property and the other 2 take it to 2 different properties. Is it split up between 3 people?
Well, and therein lies a challenge that you may have to sort out before you do this. Okay. One of the requirements of a 1031 exchange is that the seller party and the buying party have to be the same party, the same entity. Okay.
Oh, okay.
So if I'm in a partnership that owns a property and we're selling it, I can't take my piece and go buy a replacement unless we all keep our money in that company and then go buy a new property.
That LLC has to buy. That has to take out it. Okay.
Now,
those 3 partners have to go in one other part.
Yeah. Now, the exception that is not maybe directly applicable, but you could maybe work toward it becoming applicable, is where me and Bob and Joe, the 3 of us, buy a property together. Now, instead of setting up a company that owns the property, I have a company and Bob has a company and Joe has a company, and the 3 of our companies are joint tenants in common on the deed. Okay.
Oh, that's better.
So the deed, if the deed has, I'm a tenant in common with the other 2 guys, then who sold what? Well, I personally, or my company, sold my interest in that property, and my same company, or me personally, can go and buy a replacement property. So that's what you call a TIC agreement, and you can 1031 exchange a TIC interest in a property.
So I'm monopolizing all your time. Garrison and Elsa, please don't get mad at me.
All right, Mike, you're cut off next.
They're going to hit you up after this for a big capital contribution on the next deal.
I'm already in partners with one. Don't worry about that. So if I'm in a deal right now, can I split up can we split up right now and change the entity while we own it?
Yeah, I mean, you can. I don't see it happen a lot in the context of syndications, just because there's a lot of people involved. So it becomes with 3 people, it's not that big of a deal. Me and Bob and Joe can distribute our interests in the property out of the company and down to us personally, and that's really just a change at the county, to change who's on the deed, and to the tax return for that partnership would show that property was distributed to each of the 3 of us. But in the context of a syndication that has 120 partners or something like that, it's usually not done.
Yeah. Okay. Thanks for your time. I appreciate it.
It could be done. That's all I can say.
It's easier with 3 people instead of 10.
Yes, much easier. Mm-hmm. Now, if you go into it on the front end, I've seen scenarios where, investor A knows he's going to want to do this. Okay. And he goes to the fund and he says, look, I've got some capital to bring to the table. I know this is an exception that I'm asking for, but if I bring enough money to the table on this deal, will you let me hold my interest as a TIC interest instead of as a GP? Again, muddies the waters again. And if I'm raising capital, I'm not going to be cool with that unless it's really worthwhile. If I'm bringing $1 million to the table, I might make that exception. For a $100,000 investment, it's probably not worth it. Okay.
Makes sense.
I saw a question about can an active GP take cost segregation losses, or is it only against passive income? So that just depends. An active GP could take a cost segregation loss. What I think the question there is, where are you applying the cost segregation? Are you talking about the fund? The fund is going to absolutely do a cost segregation study. 99.9% of the time, they're already going to do that. You're going to get a K1, whether you're an LP or GP, and you're probably going to get, according to how much money you put into the deal, a ratable share of the loss that resulted from the cost seg study. Can you use, that's the question. And that's going to depend on, do you have other sources of passive income to offset, or are you a real estate professional? And so that's where the context matters, and hash that out with your CPA. Someone in there is mentioning short-term rentals. Yeah, short-term rentals are interesting there too, similar to real estate professional, but different criteria apply. You have to be materially involved, okay, for you to treat a short-term rental as a non-passive activity. And a lot of people misunderstand that. You're going to hear about the short-term rental hack. You can't just go buy a property, hire someone to manage it for you, and you're spending no time on it, and that is a non-passive activity for you. It's not. You have to materially participate. So there's criteria behind that. Talk about it with your CPA. Make sure you're meeting those criteria. Probably would need to log your hours. Similar to with real estate professional, you may be asked to prove, did you materially participate? And you better have something to evidence that with. So, but yeah, I like short-term rental in general. The cash flow can be really good, and it can, in some cases, produce a non-passive loss. You can do a cost seg on a short-term rental, just like with any other rental. Okay.
Here's a question from social media real quick. I'm a full-time real estate investor. I have no W-2 job. Do I still have to log all of my real estate hours if I get audited?
Well, I think the question is, are you trying to claim to be a real estate professional?
From the sounds of it, this is all they do, but they're just asking, do I have to clarify myself to the IRS and show them how many hours I spent this year?
Yes.
Okay.
Yeah, and now if you're a W-2, you work for Apple, you're a software guy, and you have real estate on the side. If you're not going to meet the criteria to be a real estate professional, then you don't need to log the hours. But if you're trying to deduct losses from real estate because you're a real estate professional, you better have a log, and that's across the board. Doesn't matter if you're a realtor, okay? You better have a log, and I'll tell you why. Because there are tax court cases we can look at and see how did they deal with this, and a lot of people misunderstand. Well, I'm a realtor. That's all my income comes from selling houses. How am I not a real estate professional? Well, there are other things that are at play there. Are you materially involved in running rentals? Okay, it's not enough to say I'm a realtor, therefore I'm a real estate professional. You're right, but do you have material participation in the rental side of things? They're going to look for that. And also, by the way, if you're a realtor, those hours don't count if you're an employee of someone else's company, unless you own more than 5%. So if you work for, some brokerage company and you're selling houses, but you're just an employee, you don't have any ownership, those are not real estate professional hours. They count if you're an independent contractor, or if you're an owner in that company, at least 5%, but otherwise wouldn't count. So yeah, probably, I think to go back to your question, I think you would still need to log the hours.
Perfect.
1031 exchange, before we kind of put that one to bed, I just want to, hit some other points on that, just to make sure people have a general sense of what to look out for there. Historically, 1031, or sort of more generally described as a like-kind exchange, could apply to a bunch of different kinds of things, not just real estate. You could, for example, sell a business truck and buy a business truck, or sell a business van and buy a business car. Vehicles were considered like-kind property, one with another. Real estate was another category. The more recent tax law has narrowed that benefit to really just real estate. So the business vehicle thing doesn't apply anymore. But with real estate, you can like-kind exchange property A for property B, as long as it's real property and real property. Now that's pretty loosely defined. You can sell raw land and buy a home. You can sell a home and buy an apartment. You can sell an apartment and buy a commercial property. Okay, all that is real estate. And so you can like kind exchange within that broad umbrella of real estate, all sorts of different kinds of things. Why would you do it? Well, because alternatively, you might be paying 20 or 30% of your gain on the sale to taxes. So if you sell your property and you deploy that cash into another property and you meet all the criteria, and we'll talk about what they are, you've deferred that tax into the next property. Okay. You haven't made it go away forever. And the inheriting is another thing. Maybe we could get into another time. If you leave your property to your kids, they might avoid the gain. But if you sell that next property without again doing a 1031, that gain is going to come back. So you've deferred it into the next property. As far as the criteria go, all right, simple, high level to know about with 1031, buy up. Okay, if you sold a property for $1 million, buy another property that costs more than that. Okay, you have 45 days to identify your property. You have 180 days to close on it. So from when you closed on the sale, you got to close on the purchase, 180 days. Okay. You've got to work with a qualified intermediary. All right. All the money from your sale goes to the intermediary. It goes into an escrow account. It sits there where you can't touch it. And then it goes into the replacement property when it closes. You touch the money, it's taxable. Okay. So don't call your CPA right after you close on the sale of a property and say, hey, what do I do with this? Can I 1031? It's already too late. All right. Plan this out beforehand. And I always suggest if you're maybe going to do a 1031 exchange, let's run the numbers. Okay. Let's do some example scenarios where we say, all right, well, I think I'm going to sell it for X. I'm going to buy this one for Y. Let's scratch it out and see if we can make it work. And maybe even before you list your property for sale, certainly, you know, in before you actually close on the sale, but you might even be planning this out before you list your property. You might even be shopping for replacement property in the meantime, so that you're ahead of the game and you can get the clock started quickly. Okay. All right.
Someone has their hand
I
raised.
have
if
a
that's
question.
okay.
Yes, I have a question.
Sure.
So I haven't purchased my first investment property yet, but let's say that next year is the year that I purchase. So to get the tax benefits that you were talking about earlier, would that still count if I purchased it early on in the year?
So if you purchased a property in, let's say, March, and it's in service as a, you know, as an income producing property, then you can start to take depreciation tax deductions on your 2023 taxes.
Okay.
Does that answer your question?
Yes. So it would be for next year technically, but yes, it answers my question.
Okay. Yeah, talk to your CPA or give us a call. You know, the one thing you want to make sure is, you know, do you meet the criteria to deduct that loss? But I would suspect that you would at least get depreciation deductions and should maybe look at doing cost segregation if you can deduct the loss.
There was a
Thank you.
question, sorry. As far as the loss, Jim, the passive loss, if you can, how many years can we carry forward that loss?
Well, you can carry it forward indefinitely, but usually something changes that will result in you using the loss. So what we're really talking about in most cases is some kind of a timing difference. Now it might be a year or it might be 10 years, but it's a loss that you're going to probably get to use at some point, unless you're just continuing to 1031 and 1031 and 1031. Okay. Now, what causes you to be able to use that loss? If it was suspended because you got the loss in year one, you weren't a real estate professional, you didn't have other passive income to offset, so you had a suspended passive loss, and it's going to carry indefinitely until I suddenly have passive income in a later year, right? If the pendulum swings, and often it does, right? You accelerate things into the year one. Very often, new businesses and rental properties included, very often have tax losses in year one, but they kind of dry up. You accelerated all the depreciation, you wrote off all the furniture and fixtures and the furnishings, et cetera. And a few years later, if it's cash flowing well, you may have a positive amount of income on that property. And so now in the later year, when you're positive, you're starting to eat into those unused losses from before. So that can happen. Or if you sell that property, generally speaking, if you sell the activity, could be a business or a property or what have you. If you sell it or dispose of it, then you could free up that loss at the sale. Usually it's in the context of rental properties, for example, it's usually I sold the property 3-4 years down the road, I sold it, I had a gain on the table because it's gone up in value, but I also have an unused passive loss and I'm going to get to use it in that year of sale. Okay. Couple of comments about inheriting. Do some estate planning. If you're growing a portfolio of real estate, highly recommend do some estate planning and think about whether it will make sense when you've ultimately kicked the can, as we all will. What happens to your property, and should you leave it behind to your heirs or to other family members, friends, etc. There is generally what's called a step up in basis on inherited property. So imagine I bought the property for $1 million. I did a cost seg study. Over the course of the last several years, I took huge depreciation deductions. Now my basis is 500. Okay. If somebody went and sold it tomorrow, even for what I paid for, it's probably worth more than that now. They're going to have a $500,000 gain. If I leave it behind to my heirs through inheritance, they generally will get a step up in basis according to the fair market value of the property at the time that they inherit the property. So if the property later is worth $1.5 million, their basis upon inheriting it is stepped up to $1.5 million, and they could turn around and sell it for $1.5 million and not pay tax on that. So you hear this kind of floating around the real estate circles. We'll just buy and buy and buy in 1031, and then you let it go to your kids. Who's going to pay tax on the gains? Maybe no one. Okay, if you do it right. Okay. Do tax
Here's
apps.
a question from social media real quick.
Okay.
What is the number one misconception that when people get into multifamily from residential real estate in regards to taxes, what is the number one misconception that most investors think from a tax standpoint?
They very often misunderstand how depreciation works, what a cost segregation is going to do for them, and what that's going to do ultimately on their taxes. So, and there's various angles that are misunderstood there. But for example, if I'm investing in a syndication for the first time, I put $100,000 in, I might think that I'm going to personally calculate and take a depreciation tax deduction that I'm going to scratch out based on my $100,000 investment. And it's not the case. The depreciation all happens at the fund level. The fund does a cost segregation study. The fund calculates the depreciation, which is just one of many tax deductions that the fund will report on its tax returns. And the net income or loss that the fund calculates gets then trickled down to all the investors. Everyone gets a piece of it according to what they own in the deal. Okay, so the guy putting the money in for the first time, it tries to overcomplicate it and think, well, am I going to have a depreciation deduction? Where is my depreciation deduction? Well, it's on your K1 in that net rental loss number. It's in that number. Okay. And that's half the battle. The other half of the battle is, can I use the loss, right? Can I use the loss because I have passive income on the table from something else in my world? Or can I use the loss because I'm a real estate professional? The general rule is going to be, I can't use the loss because it's a passive loss, and I have everything else in my world is non-passive. So that's where you have to plan it out, talk to a good CPA, and get educated on how K1s work.
And speaking of which, if you need to talk to a good CPA, I put Mr. Jim Ross's contact information, and if you have any other contact information you want to add in the chat below, feel free. But I went ahead and gave his email address below. So if you need a good CPA, definitely reach out to him. Definitely get on his book and schedule a strategy session.
Yep. We'd love to talk to you. If you're in business or real estate or have a lot of investment even, give us a call. If you're not getting good enough advice, if you're not planning ahead, we'll help you work it out.
And to add on to that, even if you think you're getting good advice, it doesn't hurt to get secondary advice. We came to him from a different CPA who classified some of our numbers a little differently, and it created a huge tax liability for us. And then we realized that, at least in our eyes and some of the other CPAs we talked to, that particular CPA was kind of categorizing some things a little a little, what word am I looking for here? Not
Unusually?
sloppily, but yeah.
Unusually, inappropriately, maybe?
Yeah, I'm trying to be super polite here. Good friend of mine, great guy. I'm not saying he did anything wrong. We just switched some numbers around, played with some things a little bit, and it created a huge tax advantage to us, which is why we brought Mr. Jim Ross on the mic tonight. Any other questions from anyone in the audience? Feel free to speak up. This is Multifamily Masters Live. We do this once a month. Next month, we're going to be doing goal setting. Tonight, we have Mr. Jim Ross. And his email address and his contact information is in the chat below. Let's see if we got any more last minute questions. I don't want to run this too late.
What happens the exit year of a syndication when the GP and LPs are paid out the most? Are these distributions, taxes, capital gains? Curious, most likely what the LPs will face. You're typically going to have a combination of capital gain and depreciation recapture, and your K1 will break those two numbers out. Some of it's taxed at a lower tax rate, and some of it's taxed at a higher tax rate. So that gets a little bit complicated, but yeah, it's mostly capital gain. And some depreciation recapture. Mm-hmm. If you have a number of properties that you self-manage, does it make sense to create your own property management company just to manage your own rentals? So the answer is depends. You know, in that scenario, you can manage how much the rental company makes, and you can engineer it in such a way that, you know, it makes just enough to make like 401k contributions, and you'd mentioned that self-directed IRA, that kind of stuff. You might be looking to take a self-employed health insurance deduction. So there can be benefits to that. Just bear in mind that if you have passive income from rentals, and then you pay management fees into another company that's a rental management company, if that company has a profit, then now you've got a self-employment tax issue on those profits. It can make sense, but you know, it's one of those it depends things. Hash it out with your CPA.
And here's a question. This is from a good friend of mine, Miss Yolanda. This conversation is geared towards the W-2. What about those that do not have a W-2 income? Do things work the same, tax benefits and depreciation, if your income comes from pensions, annuities, Social Security, capital gains, short-term rental income, limited partner, blah, blah, blah? Yeah. Is that kind of in the same category, or what do you think, Mr. Jim Ross?
Yeah. So going back to the offsetting question, what can offset what? When you're talking about passive losses from real estate or from other types of passive income, and that's a whole separate section of the law than your pension, annuity, Social Security, etc. income. So short-term rental might be the exception in that list. It's maybe in a different thing on its own, but yeah, if you have income from pensions and annuities and Social Security and so on, you'd love to be able to negate the tax on that income, and you can, depending on what you invest into. If you have short-term rentals, is it average 7 days or less, and do you materially participate? If you have other real estate that's long-term rental, are you a real estate professional? Oil and gas would be another exception. You can treat oil and gas as non-passive and negate some of those sources of income. So yeah, it's definitely something that you should be thinking about. You know, what can I do to create tax deductions to offset those sources of income? And there are options on the table.
Jim, I got a quick question. My brother-in-law wants to invest in syndications. He inherited a farm. He makes, you know, him and his brother both make each $50,000 a year passively on that farm rent. If he invests into a syndication and the K1 loses, let's $50,000, does that bring that to zero?
So if I understand the context you're giving here, I've got passive income from a farm activity, and it's passive because I don't materially participate in it. That's an important component there. If somebody else does all the work and I just get cash flow from it, that's probably passive income. And then I have a passive loss from a syndication because they did cost seg or whatever. Yes, the one could offset the other. Passive loss from the syndication, if I'm an LP and I'm not materially involved, got a passive loss there, it can offset my passive income from the farm activity. Passive can generally offset other sources of passive.
Thank you.
Awesome.
You know, and for a lot of people on this call, whether this stuff applies to you specifically or not, these are strategies, these are things that you want to be able to speak about, you want to be able to convey whenever you're out raising capital for your apartment deals. This is going to help you raise capital. So you really want to know more than the generalities, but these are conversations that you're going to have with a lot of LP, a lot of passive investors. So you do want to know the basics and you do want to understand the ins and outs of it.
Absolutely. Yeah. You're going to have a lot of questions from a lot of investors. And if you can at least be enough to be dangerous, that's going to go a long way.
And you should have a couple slides in your pitch deck kind of describing some of this stuff and hitting on some of these points, which will help you sell your investments to some of your future investors. So with that being said, do we have any other questions in the chat below? Aaron, do you see anything below?
Nothing recent. There are a lot of specific personal situations. So I think a lot of it is probably it depends kind of situation. But if you wanted, we could do a couple more of those.
I was reading through some of those as well. I think you're right. A lot of those are going to be, it depends. You need to sit down and hash it out with someone in more detail.
Absolutely. So with that being said, Mr. Jim Ross, what are 3 of your biggest takeaways or 3 of your biggest tips or tricks that you can give for anyone on this call who is getting ready right now to, you got a month left, and then you got to start thinking about your 2023 taxes. What are your 3 biggest tips, tricks, ahas?
Well, if you're not already doing it, you should have a CPA at least preparing a high level projection of what your tax is for 2023. If nothing else, it's a good thing to know where you stand. Do you have a refund coming? Are you going to need to make a payment in January for Q4? Or are there some things that maybe you could do before year end? If you don't know where you stand, there's little you're going to be able to do about it. Look at your income and expenses, especially if you're a business owner, if you're any kind of an entrepreneur. Are there things that you can prepay before the end of the year that you might need to buy or spend money on anyway in the near future? If you're going to pay expenses in January on something, and assuming you're on a cash basis, can you pay for them before the end of the year? Let's get the deduction today instead of putting it off to later. Okay. A deduction today is worth more than a deduction later. Same thing on the opposite end with income. Okay. If you're about to get paid for something and you can get paid on January 1st instead, if you have a lever to pull there, it might be worthwhile to do that. You're going to defer tax on that extra income for probably a full year. Okay. Just for the fact that you received it in January instead of December. Of course, we all want to get paid. That's first and foremost. But if moving it from the 26th to the 1st isn't going to sink your ship, then it's worth looking at doing. I would say the last thing is, maybe look at who's in your picture, especially if you have kids, nieces and nephews, neighbors, family members, close people. If you're supporting people financially, can you make them employees? All right. I love the idea of paying your kids. Okay. If your kids can be put on the payroll of your business and you take a tax deduction, income comes out of your high tax rate, goes into their income at a low tax rate or 0 in a lot of cases. You can have them make Roth contributions. You can have them save up for college tuition that way. Great planning opportunities. If you look at the whole picture, again, it goes back to that holistic thing. What's the context as a whole, and how do I, put all the pieces in the right place?
Very good points. Elsa, awesome. Random question. Do you employ your children?
Yeah, absolutely.
I plan on doing that every year. I just haven't made it happen. I'm going to make it happen this year.
You've got time. There's still time. It's not the end of the year.
One last question.
How much money did you pay your children this year, Elsa?
A lot. Jim, solo 401k, before I forget, that's another tax deduction that we as entrepreneur we should take into consideration, right?
If you have earned income. If all your income is passive income, it doesn't work. But if you have an earned income because you're a realtor, broker, you're fix and flipping, or you're a GP on syndications. Okay. Again, there too, you have material participation. You may have earned income from that. You have to have earned income to contribute to one of those things. And yeah, but bear in mind, when does it make the most sense to pay the tax on that income? If I'm in a 0 tax situation today, because I've got a bunch of losses from something, putting money into a 401k to then pay tax on it later may not be advantageous. I may pay tax later at a higher rate. Okay. Because I'll ask Garrison, what are your thoughts? Do you think legislatively in the next several years, Congress will make tax rates higher or lower?
Oh, we're going up.
I think if I'm a betting man, I'm going to bet that
we're going up.
Yeah. So if you put money into a 401k and you pay tax on it later, it may be at a higher rate, not just because your income's going up, but because the tax laws might change and the rates might be higher at that time. Okay, so that, bear those things in mind. In some cases it makes sense, in some cases it doesn't. We have other scenarios where it's like, hey, I'm making a lot of money now, but I'm retiring 2 years from now, and then my income's going to drop off. Now I'll pay tax on it 2 years from now. Great, sock money into retirement plans. Or if not, if I am in a lower tax environment, look at Roths. Okay, Roths are great. You put money in the Roth. If your tax rate's low now, it'll grow tax free, and you didn't pay much on the front end, maybe even zero.
Hey, here's a question, political question. I'm not a politics guy. I don't care about politics. I don't care who's sitting in the White House. I think it's all BS, no matter who's sitting there. But from your perspective, from an IRS perspective, from a tax perspective, do I care if it's a Democrat or a Republican? Do I care if it's Biden or Trump or DeSantis? Or does any of that make a difference to me at all?
It depends. Now, there are, for example, moderate Democrats who have enacted and are favorable toward business-friendly tax codes, and similarly, there are some centrist Republicans who are looking for where can we raise tax because we need to raise revenue. It's not necessarily one part or the other party or the other. If you had to say on average, the Republican Party tends to be more for cutting taxes in the business sector than the Democrat side does. But they're both a mixed bag, and you'd be totally right to say that you can hardly trust any of them as far as you can throw them.
Yeah, 100%. I agree with that. So with that being said, man, I'm super appreciative of you hopping on here. Thank you, Elsa, for bringing Mr. Jim Ross on. Jim's contact information is in the chat below. And feel free, if you want to give any more contact information for yourself, throw it in the message below. He has been a wonderful, wonderful, wonderful asset to our business. I sincerely think that you should reach out to him if you do not have a good CPA, or if you just want a second opinion on some of the stuff that you are working on. With that being said, Elsa, do you want to go ahead and close this out?
No, I'm all good.
Thanks, Garrison. I appreciate that.
Yeah, thank you, Jim, for coming on
Absolutely.
tonight again. And thank you, everyone, for joining us. I know it's late and it's dinner time, so appreciate your being here tonight.
Absolutely. We're Multifamily Masters. This is Multifamily Masters Live. We do this once a month. Next month, let's talk about goals. If you're watching this on social media, hit the registration button below. Register one time. You can come on all of our calls. Thank you very much, Mr. Jim Ross. Thank you very much, Miss Aaron. Thank you very much, Miss Elsa. It's been an awesome night. Much appreciated.
Thank you all.
Absolutely. See you guys.